From our world headquarters in New York of Bloomberg Surveillance, this hour we're brought to you by BMW of Tenafly, offering your best price on any new or certified pre-owned BMW. They're online at bmwoftenafly.com. He walked from Philadelphia. Stephen Schork, good morning.
Let's hear it for quasi-government-run organizations.
The railroad failed. Maybe they needed oil here. 74. You mentioned as we came on here that if we print 75, we go to what, 85?
Yes, essentially we have the market that is technically range-bound in between the high 50s on the low end and the low 70s on the high end. So what we're seeing right now is a significant battle between the bulls and the bears. So the bears right now are trying to defend that high 70 range. If they fail, we go to that next big psychological number, $75. It's a great number, divisible by 25. We all like it. Problem is, if we get to 75, 76, everyone who's selling at 72, 73, trying to defend the range will have to cover, and that will be the impetus.
That was my question. Is the short cover? Is it out there? Is the play out there?
So absolutely, and this is the scenario that we saw last year in the run-up to $147. Mind you, no one believed oil belonged at $70, $75. But every time you sold it at 75 and you covered at 80, you know what happened? Your covering pushed it to 85. Now, we already know there are a few on the street that are saying $85 is realistic for crude oil by the end of the year. This is how we get there.
I'd mentioned Edward Morris in this month's Foreign Affairs magazine with a terrific article on oil.
Well, suppose, Stephen, it were just supply and demand.
Yes.
Where would the price be?
The supply and demand would be, based on those type of fundamentals, it would be closer to $50 than $70 at this point. Mind you, $85 translates into plus $3 retail at the pump gasoline. We know even in times of good, 05, 06, post-Katrina, when we had that initial spike to $3, this is when we saw the demand destruction. People just stopped driving at plus 3, and that's when times are good. Since then, 7 million Americans have lost their jobs. We can no longer extract equity out of our homes. Our credit card bills are mounting up. Our mortgage rates, delinquency rates are at record highs, and yet the market, speculators, are pushing retail gasoline to over $3. We can't afford it, but again, this is a market that is not trading on fundamentals.
Is this something recent for oil to operate on some other basis than just supply and demand? Oil's been traded now publicly for going on 30 years.
Yes, but you have to keep in mind, up until the 1990s, when we had oversupply and a lack of demand, Wall Street, commodity traders, look, the guys in the New York Mercantile Exchange pre-2000, let's face it, they were Wall Street's B team. No one coming out of Wharton or Harvard went down to the New York Mercantile Exchange in their right mind to trade. But now, post 9/11, post Enron, post the coming out of the 02 recession, commodities are the hot market. So, mind you, you have a lot of people that don't know the value of a BTU, but they're trading based on correlations to the dollar in the stock market relative then to stocks of inventory in the ground.
With us, the Schork Report's Stephen Schork from Philadelphia. We really appreciate his spirit. As Amtrak failed today, he walked from Philadelphia.
Oh, it was Amtrak, of all the possible culprits around here.
Oh, and absolutely. And just wait until Amtrak the U.S. health industry. So let's
that was his opinion,
something to
not
look forward
ours.
to.
Right,
Let's
exactly.
make that clear.
Okay,
well,
yes.
not necessarily. Look, one of the things we saw last year in the run-up to 150 was sort of new players in the game.
Yes.
Pension funds, university endowments, stuff like that. Are they still in, or are they out, or are they a factor at all?
I think a lot of that dumb money did get priced out of the market, but what we did see is that they let the genie out of the bottle. And so now, for instance, Trafigura, which is a significant physical commodity trading company based in London, all former Mark-rich people. These people know how to trade oil. They just started up a $500 million hedge fund at the beginning of this year. So the hedge fund genie is out of the bottle, but now it's being traded by people who actually know to value oil.
But Steve, this is critical. It's like, is this going to be just a repeat to one whatever? I mean, it's a tangible asset, isn't it? Last I knew.
Yeah.
We're up to our eyeballs. Is that's a cliche, but it's true.
Oh, no, we have it come out of the wazoo. That is absolutely. Look.
Ken is buying, what are you going to get? Like 800 miles to the gallon on your cash for clunker trade-in?
Something like that.
Something like that. Forget about microeconomics and bow tie. Did you notice, Steve? No bow tie
No bow tie. Yeah,
Very good.
I'll take my tie off now.
Andrew from New York sent a memo, and he said, hey, Tom, lose a professorial look. Okay, so the point here is, at the end of the day, Is this just a repeat performance of what we saw 18 months ago?
Oh, absolutely. It's another mini bubble being inflated. It's not being inflated by supply and demand. What it has is it has all the telltales of a bubble. High prices now are becoming the justification for high prices. So it's not the fact that, look, heating oil, distillate diesel inventories are at the highest level since January 1985. The gasoline driving season is over. We're going to end the season over the psychologically important 200 million barrel mark. Inventories, crude oil inventories, OECD worldwide are at 60, forward covers at over 60 days, well above the historical averages. So we are literally, inventories are brimming. Demand is questionable, and yet we are pricing this market up again as if the stuff was being given away.
So then, how do we hedge against that? I mean, not as a commodity speculator, but just as a consumer.
Well, we are doing the correct thing. Now, mind you, gasoline especially is the most inelastic demand-wise of all of the commodities. Therefore, it takes a very large spike over an extended period of time for consumers to alter their behavior. But we've had consistently high prices now since 04, 05. We are now starting that transition period where we are now trading in cash for clunkers, what have you. But even the normal transition of our automobiles, we're not trading in Cadillac Escalades to get the next biggest and largest car right now. We're trading in our Escalades and so forth for the Priuses. So the consumer is doing it. This is a problem now. Now, mind you, with economics, high prices are the best cure for high prices. So these high prices are altering our demand picture. And it worked, mind you, in the natural gas market, and it will work in the crude oil market. 10 years ago, no one could envision that we have more natural gas domestically produced than we do now. And the only reason we got it is because natural gas prices spiked in the early part of this decade. It led to innovation, and we are now literally taking gas out of rocks right now because it is economic. Why? Because there was that pot of gold at the end of the rainbow, and we were able to grab it. We saw it in natural gas. It can be done in oil. It will take time, however.
Stephen Schork from the Schork Report. Once again, we have crude oil. It's back down below 74, but not much. 73.90, and Tom, that is still up $1.04, about 1.5%.
Yeah.